Welcome to enrichminds.com and our session on value of a company. In this session, we shall study what the value of a company is and why it is important. It is at the core of our decision to invest and our hope to make money from the investment. For publicly traded companies, when you hear about a company being valued at a certain figure in the news, you're usually hearing about market capitalization. That's equal to the company's share price multiplied by its total number of outstanding shares, and is a quick and dirty way of valuing a whole company. A newly high valuation just means the company's stock price has gone up. For private companies, any figure you hear about in the news is probably one that's recently been negotiated between the company itself and an investor. These negotiations can happen when an investor is taking on an ownership stake or buying the company outright. So, in the case of a public company, the market capitalization of the company, also called market cap or equity cap, is the product of the share price and the total number of shares outstanding. But if you believe, and you are right, that the actual value of the company is higher or lower than the market's assessment, you will make a lot of money. If you believe that the value of the company should be higher, then you should buy that stock. If you believe that the value of the company should be lower, you can short the stock. But shorting a stock is a very risky business, and you must be very, very careful. We shall discuss and learn valuation techniques later. At this time, you should know that shorting or selling short a stock means you borrow shares in a company from someone else and sell it in the market. If the price goes down, you can buy the shares back at a profit and return the borrowed shares. But if you were wrong and the shares go up in value, you may lose a lot of money by having to buy the shares you sold at much higher prices. So shorting is a very risky thing to do. If it were easy to value a company, the share prices would not be moving all over the place all the time. Companies are complex. Coming up with a value may mean considering all the assets the company owns, its intellectual property, its debts, its future profits, and more. It is an art and also a science. There are lots of different ways to value a company, and one has to make a number of assumptions. We shall learn valuation techniques later on, but none of it is an exact science. Valuing a company requires judgment and assumptions, and every methodology to value a company involves many assumptions. Valuation is all about predicting the future, and it is always impossible to predict anything with absolute certainty. If you think the economy is about to go into a recession, then you'll expect the company's profits to be lower. In that case, the company will be worth less. If you think the economy will keep on roaring, then you'll estimate higher future profits. In that case, the company will be worth more. They don't trade often. The process of buying and selling something helps set what it's worth, but it's rare for a whole company to change hands. Finally, as they say, beauty lies in the eyes of the beholder. It is impossible to model demand for a company as a target to a potential suitor. Even investor demand and supply is impossible to model accurately. because it changes all the time. If it is so difficult, how is the value of a company even determined? There are many ways to value a company. Experts can disagree on which is the right way, and it's possible for one method to be better suited in one situation, but another to be better in a different context. Here are a few ways. First, start with share price. Publicly traded companies, meaning ones with shares that trade on an exchange, have a readily available share price, which can be used as a starting point for valuing the whole company. Second, look at profits or cash flows. Analysts may estimate what a company's profits will be for the next 5, 10, or 20 years. Then decide what they think those future profits are worth today. Some investors and analysts prefer to focus on cash flows instead of profits. Third, look at assets and debts. Adding up everything the company owns and subtracting what it owes can give a low-ball estimate for a company's value. This method can make sense for companies that are nearing bankruptcy. Fourth, compare with similar companies. The valuation of similar companies that have recently been sold can be a starting point or a sanity check for a particular company's valuation. There are other ways to value a company as well, but these are the most common ones, and we shall study at least 2 of these methods in some detail later on. But valuing companies is trickier than valuing, say, your 2012 Kia, because doing so rests on complex calculations and judgment calls. Companies are generally valued by looking at financial metrics such as profits, cash flow, share price, assets, and liabilities. However, the private company valuations you read about in the news are often negotiated figures rather than the result of a single precise calculation. A company's value can affect its ability to raise money and do business, and also affects the income and net worth of its investors and other owners. Why is it important? First, investors' returns. Share prices are directly connected to a company's value. The higher the value equals bigger returns. Second, company transactions. A company's value may affect its ability to raise money, buy other companies, or sell itself. Third, employee compensation. If employees receive stock, a company's value directly affects their compensation. Fourth, owner's net worth. Kylie Jenner is only worth $1 billion because people have estimated how much her company, Kylie Cosmetics, is worth. And fifth, overall economy. When company valuations are rising, investors and owners feel richer and the economy does better. The reverse can happen when valuations fall. In summary, let's look at the main takeaways. First, like the value of anything, a company's value represents what someone might pay for it. Sometimes a company's valuation rests on elaborate number crunching, while in other cases, it may rest on a handshake. Second, valuation of a company is a highly subjective topic and everyone has an opinion. If you are convinced about your opinion and you are proven to be right, you could make a lot of money. Thank you for your time. Until next time then, stay enriched and strong.